So while you and I were sitting around eating our Thanksgiving dinner, enjoying time with family last week, banks closed 64 U.S. branches. Now, I don't know about you, but that seems kind of concerning to me. Interestingly enough, they did it over a holiday week when everyone else was distracted and no one would notice. I'm sure that had something to do with their stock price being affected, but anyhow, according to this article, 64 U.S. bank branches filed to shut down. And the list is JP Morgan Chase with 18 filings. They closed 3 in Ohio, 2 in Connecticut, and South Carolina, and 1 each in 11 states. Citizen Bank is on the list, and they came in third with 8 branch closure filings. Bank of America, Citibank, and altogether it says that there was 64 branches that were shut down. So, what I think is going on with these banks is they see the writing on the wall. There is record high credit card debt right now. Well, guess who issues those credit cards? The banks. So they can see these delinquent payments, they're seeing the writing on the wall. There's also a record high number of delinquencies for car notes. Well, guess who issues those car notes? The banks issue those car notes. So they are trying to cut costs and prepare and stem for any kind of bleeding that may happen in 2024. At least that's my opinion. I mean, why else would these banks be trying to cut costs so much? I kind of know this firsthand simply because I had a line of credit that came due this year. It was a yearly revolving line of credit for one of my commercial apartment buildings, and I had $150,000 drawn on that line of credit. Well, they wouldn't renew that loan. They actually initially wanted me to deposit $100,000 in the bank, and I wasn't willing to do that because I only had $150,000 drawn on this line of credit. Why would I deposit $100,000 into the bank? When a bank asks me to deposit a large sum of money, when I already hold my rent deposits in that bank, it kind of makes me a little bit nervous, so I declined to deposit that money, and they declined to renew the line of credit. And from there, a staring contest ensued where I had to kind of go around all the other local banks and see if they would finance this line of credit, which was in a second position. The original bank held the first position as well, and nobody would do just the second position. So then I was forced into saying, hey, can you finance all of this property, which is a 55 to 60% loan to value? And while those banks initially seemed very enthusiastic about financing that property, they ended up declining. And I went to probably 3 or 4 different banks, and they all pretty much said the same thing. So that gave me the impression that banks were tightening up their lending practices extremely. And after about 4 months of my note being on the book of the original bank, they came to me and said, okay, we can just term this out. And, that's obviously because they don't want to have to take back any properties. They're in the business of issuing loans and, collecting the interest on those loans. And I was a performing loan. I have $2.5 million with this bank. So they probably shouldn't have ruffled any feathers with me because as soon as this situation kind of irons itself out and rates come down, I'm just going to take my business elsewhere, because they could have just termed that line of credit out and it would have been no issue. However, I'm not really sure who won in this scenario, because I ended up with a 3-year fixed, 15-year amortization, 9.5% interest on my second position loan for this apartment building. But it's better than the alternative, which is, them trying to foreclose on the property, which would have made no sense anyways. But I digress. I went into that whole spiel to kind of give you the impression that I know firsthand that banks are tightening their lending practices. You can go look at the SLOOS report, the Senior Loan Officer's Opinion Survey, which was issued last month, I think. They issue it every quarter, and that talks about banks tightening their lending practices on commercial real estate. So banks see the writing on the wall. They see some sort of contraction in the U.S. economy, and they are preparing themselves for it. So to me, there also is writing on the wall, and I think there's going to be some kind of recession in 2024. I did another video about this debt that is coming due in 2024 and 2025. And basically, if you were to have gotten a loan 3, 5, or 7 years ago, which is a typical fixed term for commercial real estate can be a residential property, say somebody that has an Airbnb, a second property that they use as an Airbnb, or just a single family home that they rent out. But in my case, it is multifamily properties, 5+ units. That has to be on a commercial loan typically, and those are 3, 5, and 7 years, and they're amortized over a 15, 20, 25 year period. Well, there is debt that is coming due next year. There's somebody that got a loan 3, 5, 7 years ago, and they got it at a 4 or 5% interest rate. Well, that note has been paid down some, but that debt has to be restructured or termed out and set to a new interest rate. Basically, you're subject to whatever the market interest rate is when that term is up. And the bank can decline, kind of like they did in my situation, they can decline to renew that debt. They can just tell you to take that business elsewhere. But typically what they do is they will just offer you the current terms, whatever the market terms are. Well, guess what those terms are? Those are 8.5%, 9.5% for a commercial real estate loan. Well, when that debt comes due, those people are going to have some sticker shock when they see this 9.5%, 8.5% interest rate, because they may not cash flow anymore. If you just overpaid for a property a little bit, you could be in trouble. And I'm telling you this because that is going to cause a problem in the economy. That is something that the banks foresee. They're already seeing it in office commercial real estate. And, they're seeing it probably in large commercial multifamily properties that had some sort of bridge debt, some kind of non-fixed rate debt that has come due this year or will come due. And so they see the writing on the walls and they're trying to cut expenses and stem the bleeding that is probably going to occur. You could just look at the reports in the news about, again, the high credit card debt, the car loan note delinquencies, student loan debt has restarted last month. So people are going to be unable to make their obligations, and they're going to choose which item they're not going to pay on. And I'm a landlord, I'm an investor, so hopefully they don't choose rent, which typically they don't. It's usually higher on the list. But these are some things to consider. You can pay attention to the news and you can see the writing on the wall. So I would suggest you sit on the sidelines. It's not a good time to purchase a home. I think this is the top of the market. I think there's going to be a correction, if not a recession next year or the beginning of 2025. So I would sit back with some cash if you're an investor and wait for these opportunities to pop up. Or if you're looking to buy a home, I would sit back and wait for these prices to come down because it's virtually unaffordable. I also did a video on that if you want to go check that out. But definitely consider these things. And remember, these banks are seeing what is to come. So remember, there was a crisis at the beginning of the year with Silicon Valley Bank, and they basically needed to be bailed out. People did a run on deposits. They took all their money out of the bank. Maybe it's a good idea not to leave your money in the bank. I think that that's probably an issue right now as well. That bank that wouldn't renew my line of credit wanted a $100,000 deposit. Why would they ask me for a $100,000 deposit? Well, it's because they don't have enough deposits in the bank. It's a small credit union local to me, but they actually need deposits, regulatory. They need deposits, a certain amount of deposits to issue a certain amount of loans. So if they're not making their regulatory standard, if they're not meeting the quota for what they need, they're going to be trying to get rid of loans on their books or encourage people to put deposits in the bank. But that's not a good sign. If the bank's books are that bad that they got to be asking people for deposits, it's not a good sign, which means you probably shouldn't be keeping your money in the bank until all this stuff gets back to normal. Anyways, that's just my opinion. If you got any comments, leave it down below. I'd like to know your thoughts on the economy and if you think there's going to be a recession. As always, I appreciate you watching the video. Please like and subscribe. Until next time.